Welcome to Deep Economic Thoughts with economist and best-selling author Ivan Illan. Once in a while, Ivan shares an unscripted, though potent, idea related to economics or the capital markets. This may be of interest to financial advisors and retail investors alike. Enjoy.
Hello and welcome back. This is Ivan Illan, the founder and chief investment officer at Aligne Wealth Advisors Investment Management, also known as AWAIM. This month, here in October 2023, I wrote an article when, well, I know the name of the article, but let me read it. What a flattening yield curve means for future fiscal fitness. What a flattening yield curve means for future fiscal fitness. This is not a horribly complex subject, but it is certainly something that few retail investors, for example, are talking about, during the golf game or at the bar. No one's really lining up to talk about the yield curve. But it's unbelievably important and incredibly impactful for how capital moves, for how decisions around money are made to make investments in one type of investment or allocation versus another. And for most of the time in quote unquote normal economic conditions, you will see an upward sloping yield curve. And all that means is that very near-term, short-term debt, whether it's government debt, corporate debt, bank debt, short-term lending of any kind, that is usually done at very low interest rates relative to longer-term lending. So a loan that a government is taking or a corporation is taking or an individual is taking for only 12 months should be a lower rate of return. There should be an expectation of a lower rate of return for that lender relative to someone who's lending out money for a longer period of time. And that is a normal shaping yield curve. So maybe 1 year debt is, being, maybe there's a 3.5% interest rate around 1 year paper, 1 year loans, and 10-year loans are, say, 6%. And that is the normal thing throughout most of economic history, that we have an upward sloping yield curve. So the longer you go out in maturity, the higher the interest rate should be. Over the past year and a half or so, a little bit longer than that, since the Federal Reserve has been increasing the Fed funds rate and doing that hike very rapidly, we have seen an inversion of the yield curve, meaning that very short-term rates, short-term debt, is actually higher than intermediate, call it 3 to 7 year paper or debt, and even longer than 10-year debt or 20-year debt, or higher than 5-year debt, higher than 10-year debt. So that is an inverted yield curve where short-term interest rates are much higher, or just higher, but in this case, they've been much higher than longer-term interest rates. And so recently, we've begun to see a bit of a change in this, and it's very rare. I mean, not a lot of people have lived through, or certainly not invested through, periods of normalizing yield curves, meaning going from a period of time of inverted yield curves to upward sloping yield curves. So this is a very special period of time. and something that should not be overly discounted or dismissed as not a really big deal. It's actually an incredibly big deal. And in my Forbes article of what a flattening yield curve means for future fiscal fitness, I really detail various considerations. Chief amongst them is you got to be very aware of, if you are invested in a portfolio or your 401k or any kind of investment where you don't necessarily understand the very specific maturity of any bonds that you have exposure to, this is a time to get really familiar with the maturity schedule of the bonds that you own. Different segments of that yield curve are going to behave differently as this shape of the yield curve changes. This is very normal to expect this, and very natural that there's going to be price volatility, continued price volatility in the bond markets. And most people are not familiar with bond volatility, bond price volatility. Most people are familiar with stock market price volatility. Well, guess what? The bond markets are price volatile too. So don't be surprised as they continue to be volatile, and get advice if you're not exactly sure how to navigate around it. Financial advisors or different types of investment professionals can guide you to navigating this issue. They may or may not be able to guide you depending on their experience and their expertise, but that's certainly something we do at our firm, and we care very deeply about the yield curve, the shape of the yield curve, and the changes to the shape of the yield curve. And so, and the advisors we work with care very deeply about these issues as well. And so I would encourage you to review the Forbes article and give it a good read so that you get a little bit more appreciation for it, because it has implications for CFOs and the kinds of decisions they're making currently around their short-term money, their working capital, as well as longer-term investments, and the worthiness of allocating capital to certain types of expenditures or taking on certain kinds of financing and debt in order to continue financing growth in different formats that it may take for a particular company. And of course, there's been tremendous implications for the federal government in its very high short-term interest rates and the level of interest payments that the federal government is now paying. It's an astronomical amount. You've probably seen some reports, but essentially, the federal government of the United States is now paying as much money in interest on its debt as it is in its military-industrial complex. That's quite a lot of money, and soon to eclipse the amount of cost associated with Social Security and in other types of benefit programs associated. So this is something to really be aware of and pay attention to as we're really entering this new phase of the debt markets, the capital markets, all of which on the other side is a very positive thing, where fiscal fitness actually takes place because money costs something. And when money costs something, it actually begs the allocator of money a question. Is this really worth it? Allocate my money in this particular area. Am I going to be receiving a rate of return that is commensurate with the risk that I am taking? And risk can be longer time periods, for example. That's a simple form of risk. Longer the time period, the more uncertainty. And yield curves are really embedded in this understanding of longer periods of time have naturally more uncertainty related to them. And coming from a period of inversion of your yield curve going to a normal upward sloping yield curve is actually acknowledging a very basic principle of the time value of money. So So please reach out to us if you have any questions here at Aligne Wealth. We're always happy. We have advisors that are so very happy to answer these questions and dive into a conversation like this more deeply, or review a portfolio you may have, that whether you're an advisor managing money for your clients and just want another perspective on what your risk exposure is within your bond segment. We're very happy to have that conversation. Thank you so much for joining me for this deep economic thought, and look forward to being with you again next month. Bye.
For more deep thoughts, please subscribe to this podcast. Also, please feel free to visit www.ivanillan.com to submit questions or topics through the contact page. Until next time, keep thinking deeply.